We're going to dive into 4 investment legends and the portfolios that they hold right now. And we'll go ahead and roll them all back 5 years. That way it's going to be the same market and the same timeline, where one of these portfolios would have turned $10,000 invested 5 years ago into $65,000, and another would have been $19,000. But a third barely even doubles their money. This is 4 completely different futures, and I'm going to show you which style wins, which one loses, and why it matters to every dollar you invest. Now, here's the plan. We're going to look at the portfolios that these 4 legends are holding right now, their biggest positions, where they overlap, and where their styles split in completely different directions. Then we'll apply those current portfolios backward across the same 5 years to see how each style could have performed. And I have to say that the gap is massive. The best style would have grown almost 560%, while the weakest would have been closer to a 90%. It's the same market, totally different outcomes. So as we go ahead and feel free to pick your side. Which legend style do you think is going to come out on top? And more importantly, which one is going to be at the bottom? Just a quick note that I am using their current portfolios and I'm just applying them backward. So I'm the first to say this isn't perfect, but it's a clean way to compare 4 completely different investing styles within the same market. Let's talk about how much these legends actually agree on, because the answer is shockingly very little. Out of more than 120 combined holdings, the 4 of them only share 3 different stocks. That's about a 2.5% overlap rate. 97% of their portfolios don't even touch one another. However, those 3 shared names tell you exactly what the smartest investors on earth quietly agree on. The first overlap is Alphabet, or Google. It's owned by Buffett, Pelosi, and Ackman. 3 completely different styles, and they're all pointing to the same core idea. Search, YouTube, and cloud are the toll booths of the modern world. The second overlap is Amazon, again held by Buffett, Pelosi, and Ackman. Different strategies, but the same conclusion. AWS, logistics, and consumer scale are infrastructure right now, and they're not optional bets. And the third and most obvious overlap is Apple. It's direct for Buffett and Pelosi, and it's indirect for Gates through his nearly 30% position in Berkshire Hathaway. So once again, 3 of the 4 legends end up in the same place, the most profitable consumer engine on earth. So out of everything that these 4 legends hold, the entire overlap just comes down to 3 pillars. Happens to be search, it's cloud, and one of the hottest brands of all time. So here's what this should be telling us. If you want to build a portfolio that every legend would respect, regardless of your style, then you probably want to start with these 3. That happens to be the foundation, the 2.5% that they all agree on. And everything else, well, that's where your worldview starts to take over. Because when you get outside of those 3 stocks, these portfolios split into 4 completely different worlds. And when you roll them back over the same 5 years, you end up with a huge gap, where the strongest style grows almost 5 times more than the weakest one. Now that we understand the overlap, which is that tiny 2.5% that they all share, let's break these portfolios apart and look at the machines behind each one, because each legend is really running a completely different model of how the world works. Now, I want to discuss today's sponsor, Humanoid Global Holdings, which is a publicly traded investment issuer focused exclusively on humanoid robotics and embodied AI. The company provides retail investors access to an otherwise private industry projected to reach $5 trillion by 2050, according to Morgan Stanley, with over 3 billion robots globally by 2060. Here's the opportunity. Nearly every pure-play humanoid company is private. Figure AI raised $1.8 billion at $39.5 billion valuation, with NVIDIA as a notable investor. Agility Robotics pulled in $651 million with backing by big names like Amazon, where retail investors have no direct access. Tesla and NVIDIA aren't pure plays. Robotics ETFs are diluted across adjacent sectors. But Humanoid Global is different. It's a VC fund structure that trades publicly, deploying capital across the entire humanoid value chain. The portfolio includes Agility Robotics, which is building digit robots for Amazon warehouses, Apptronik developing Apollo for manufacturing, Formic Technologies providing robots as a service. They're covering hardware, software, and deployment with active management, and a technical advisory committee from top universities. The market cap is roughly 38 million Canadian fully diluted, where the stock is up quite a bit year to date. Humanoid Global offers something that you can't easily replicate: liquid access to private humanoid infrastructure. Global Humanoid Holdings is available through brokers like these right here on the screen. Also, feel free to check out the link down in the description to learn more. Let's begin with Warren Buffett, and his biggest driver today happens to be Apple, almost a quarter of his entire portfolio. And if you applied that weighting backward, Apple alone would have done most of the heavy lifting. Now, American Express and Bank of America may have added some good, steady growth, but Kraft Heinz would have been a major drag. Sector-wise, Buffett today is really concentrated in financials, energy, and consumer staples, all businesses that are built around stability and cash generation, exactly what you would expect from Buffett. Over the same 5-year stretch where the S&P 500 returned 84%, Buffett's current mix would have delivered roughly 96%, with a CAGR of around a 14.3%. Now, as a reminder, this isn't his actual return. This is just using his current portfolio, looking back at the 5 years, for which we're going to do at each of the different legends. Overall, this is the kind of portfolio that is designed for stability. And no, you're not going to get a lot of fireworks. Next, we'll cover Bill Gates. And his portfolio today is anchored by 2 major positions. You've got Microsoft and you got Berkshire Hathaway. And when we look back on these, those 2 holdings alone would have driven the majority of their 5-year performance. And he does have Waste Management and Canadian National Railway that added really solid growth, while names like Coupang and FedEx might have weighted a little bit differently on the results. And when you look at his sectors, he happens to be split across tech, industrials, transportation, and a large indirect exposure to Buffett through his Berkshire Hathaway shares. His is a portfolio that's built around the physical backbone of the economy, with a layer of Buffett's framework right underneath. And if you happen to compare his to that same 5-year period of the S&P 500 of an 84% return, Gates' mix would have delivered around a 195% return, which is a compounded annual growth rate, CAGR, of roughly a 24.1%. That happens to be a very strong outcome from a portfolio that leans so heavily on durable infrastructure and proven operators. Now we'll go on to Bill Ackman, where his portfolio today leans heavily on platforms and modern consumer engines, names like Google, Amazon, Uber, Brookfield, Hilton, and Chipotle. And when you take a lens backwards and look at his, those positions definitely would have driven the bulk of his 5-year return. Now, because his portfolio is so heavily concentrated, the upside is tied so closely to just a handful of winners. And at the same time, the same concentration means mistakes show up real quick. Hertz and SEG are 2 of the positions that could have pulled on the performance. Once again, my disclaimer is that we're using his current portfolio. We're not using his actual that he had over time. This way, we're just keeping them all apples to apples. And when we look at the sectors for Ackman, he happens to have a mix of platforms, restaurants, logistics, and real estate operators. His happens to be a portfolio that's built around scale, brand strength, and high conviction bets. Now, against that same 5-year backdrop where the S&P 500 was 84%, Ackman's current mix would have produced around 260%, and that's with a CAGR of around 28.4%. It's a profile that really rewards conviction. And next, we'll move on to Nancy Pelosi, where her portfolio today is really built around the core components of the AI supply chain. Think NVIDIA, Broadcom, Google, Microsoft, Palo Alto Networks, CrowdStrike, and Vistra. And when you look backwards, every single one of those companies drove insane growth for her. NVIDIA and Broadcom alone carry the majority of the weight. And then you have cybersecurity names like Palo Alto and CrowdStrike. They had a lot of high growth exposure, while Vistra represents that energy backbone behind AI's power demand. Honestly, Tesla out of her grouping is one of the few that might have softened the overall return. And when you stack up her sectors, she's really concentrated into semiconductors, networking, cybersecurity, and electricity generation. Effectively, it's the entire infrastructure layer that supports this entire AI boom. And when we go back and look at that same 5-year window against the S&P 500's 84%, Pelosi's current mix would have delivered around 556%, with a CAGR of roughly 45.6%. And I'm sorry, but when you see a number like that, you can't help but say to yourself, holy shiitake mushrooms are amazing. You know what else is amazing? Pressing that like button so my content can continue to grow. That is exactly the kind of performance that you would expect from a portfolio that's positioned directly in front of one of the strongest technology waves in our lifetime. There's a reason why her and her husband are constantly being idolized in investment articles. And they also bring in a ton of cash from their options trading that isn't even being accounted for here. Now for some S&Gs, I decided to stack up my portfolio to see how it compares. Now, I want to be completely direct about this. I am not claiming to be a legend. Some of my biggest winners came later in the cycle, and some of my losers were rebound bets that really haven't even shown up yet. But the framework is real. You have AI hardware, semiconductors, cloud software, and a small basket of asymmetrical technology plays. And when you take that same lens and look backwards on my portfolio, it would have had a 932% return, or a CAGR that's near 60%. And here's my point. You don't need to be a legend. You just need a style that matches how you see the world. And of course, you need the conviction to stick with it. Look, this is not about claiming perfect execution. It's just about keeping the comparison consistent within the format of the video. And as a quick reminder, I do share my portfolio in my free newsletter, where you can subscribe down in the description below. And like I said, everything is free. In terms of overlap, the bulk of my portfolio aligns the most with Pelosi, about 27%, through NVIDIA, Google, Broadcom, Microsoft, and CrowdStrike. And then I overlap with Buffett at around 15%, mainly through Apple and Alphabet. And then we have Gates, who shows up at about 8% with Microsoft and Berkshire. And then we have Ackman, which is the smallest overlap at roughly 6%, almost entirely through Alphabet. Now, when I look at my strongest contributors in this backwards test, it happened to be NVIDIA, Palantir, Broadcom, AppLovin, and several of the semiconductor names. And I also have a small position in crypto, which added some upside as well, although it had a lot of volatility with it. And like any real portfolio, I've got a few on the other side too. And I have some early stage bets and a few of the quantum names, which I often talk about in my videos. Now, sector-wise, I am concentrated in AI hardware, cloud software, semiconductors, and a small frontier basket that introduces real variance in the form of asymmetrical investing. And really, that's the whole point. Every investor is going to end up with their own style. Whether you lean towards stability, infrastructure, platform, or AI, the mix that you choose shapes the future that your portfolio could experience under the same market. And I have to say that in 15 years, when I'm closer to 65, that my portfolio is going to look completely different than it does today, because I'm going to shift more towards a defensive stance. And when you boil it all down, you have 4 legends and 1 regular investor that all end up proving the same thing. Your portfolio reflects how you see the world. Some styles chase stability, and some lean into infrastructure, while some bet on the platforms. And some of us concentrate heavily into AI and the future. Like I said, we all invest in what we know. For me, that's technology. I grew up working in electronics in the military. I studied engineering in college, and I worked in machine learning while I was at Amazon. So naturally, my portfolio is going to lean towards AI, chips, and software. I think it's important to acknowledge that there isn't a single right answer, but there is a right fit for you and the way that you think, and the risks that you're willing to take, and the kind of outcomes that you're trying to build toward. So as you look at these 4 different machines, and of course mine, you got to ask yourself which style feels closest to your own. Because once you know that, then you can build a portfolio that actually matches who you are as an investor. I'd love to know in the comments which investor type that you align to the most. As always, thank you so much for watching.